Let's get in Siddhartha Khemka then, head research of Motilal Oswal Financial Services, joins us on the show. Hi Sid, morning. First time we're speaking this New Year, so Happy New Year to you. Well, what do you make of the banking updates you've got? You heard what Mr. Mondal had to say with regard to CSB, but anything you particularly liked, something that a couple of banks that you're positive on for the remainder of this calendar year? Sid, we'd like to hear you. You'll have to unmute yourself.
Yeah. So good morning, Nigel. Thanks and Happy New Year to the entire team at CNBC and to all the viewers of CNBC. So coming to the banking space, yes, what we are seeing is that things have started looking better. But if you look at credit growth, we are expecting the FY25 system credit growth to kind of ease down to around 11%. Well, the deposit growths are improving and CASA is something that remains a challenge. What we are seeing again is that while the private banks, the growth could be much lower, overall private banks, we are expecting a net profit growth of 2%. PSU banks continue to report stronger growth of almost 36%. In this environment, what we like some of the large banks, for example, ICICI, which has consistently delivered strong performance. Asset quality remains robust. Margins, although have moderated, but we believe that this pace of compression has now slowed down, and we are expecting stability in the NIMs whenever the Fed rate, the RBI rate cut happens. That will also be positive. So ICICI, SBI are two large banks that we like. HDFC Bank, we believe that the post-merger issues and challenges are now largely behind, and the bank has managed to navigate them. Last quarter, we saw the deposits growth improving, margins stabilizing, and we are expecting a steady growth from HDFC Bank. So clearly, from the banking space, we like the larger ones: HDFC Bank, ICICI, and SBI.
Sid, hi, morning. That last point, Nigel and Lata, what Mr. Mondal made, right, which is about credit costs for, especially, he said, especially in gold loans, credit costs is nothing, is the lowest.
Yeah, because the collateral is very good, as good as gold.
I was wondering, credit costs is usually, realized credit cost is zero in gold loans across the board. It's never, and that is the attractiveness of gold loans as a lender.
Yeah.
But that point, Lata, which you made, which is people are using gold maybe because they don't have anything else. That was also the big story in the second half of 2024.
Absolutely.
That, maybe stress is rising. So anything you're picking up, I mean, you speak with bankers all the time.
Yeah.
Is it starting to peak? Will we see a peak in Q4 of FY25, that is Jan to March, or not really?
There are as many opinions as people you speak to. We had the SBI chairman on the 1st of January, and he thought that, our loans are always secured. We did not see any rise in bad loans and defaults in the unsecured segment at all. And he says, we normally have salaried people, and to PSU salaried people as our account holders, so we don't have a problem. So it really depends on whom you speak with. But yeah, MFI companies...
What about MFI? Any specific insight on that? Because the market assumption is Q4 it'll peak. I mean, so this is the quarter.
Yesterday, which we had in the morning, MFI companies, that MFIN, their SRO, had put in guardrails saying nobody shall give more than 3 loans per borrower, and everybody had to sign up on that. Now they have pushed, that was supposed to become effective Jan 1st. They've pushed it now to April 1st, saying that, people are having problem meeting it. I mean, what are you saying? You should not be pushing this.
Yeah.
So my sense is there is pain at the bottom of the pyramid, and, typically an MFI loan, the default cycle takes about 2-3 quarters only, because it's a small loan.
Correct.
So if you want to see it away from bank balance sheets or NBFC balance sheets to go away, I think that will be by September it will ebb away. But that doesn't mean pain at the bottom of the pyramid ebbs away. The pain on the balance sheet ebbs away.
Absolutely. And I remember reading a Ambit note. They were linking the slowdown to auto sales, to some of this. I mean, actually, they were linking it to the MFI, on the MFI side as well, because, they've done some work, and we'll probably invite the analysts there.
There's also the problem that now all the banks are afraid to lend to corporates. For that, after the last decade blow up. Corporate is a bad word. Everybody is into retail. No, retail is overserved. All
Although
banks
that is
are
also
there.
turning. I mean, that sentiment maybe. We
I
don't know.
hope so, but I mean, I think it's an overserved market, and therefore you're going lower and lower in terms of the risk quality.
What is worth doing is worth overdoing, right? Always, and that happens. Sid, good morning again. So, just open-ended question as you look into 25. Any top ideas? Anything which you think will make money for viewers on an absolute basis?
Yeah, definitely. So morning, Prashant. So I think exports recovery or revival is something that we believe would be a key theme to play out in 2025. A demand from some of the key regions in US, Europe are improving. We are seeing the effect of the 100 basis points Fed rate cut plus the expected corporate tax cut that Trump has promised after coming to power. So those things will definitely help improve demand environment. Plus, rupee being at all-time low, that is also structurally positive. So IT, pharma, these are the two subsectors within the exports recovery theme that we like. Within IT, what we like, HCL Tech is our preferred pick given its diversified business model. It has investments into the next-gen platforms, positioning it well for the Gen AI revolution and the future growth in the client spending. So we are expecting margins improvement as well as almost 8.5% growth in USD terms over the next 2 years. So that's a preferred pick there. We have a target price of 2,300. Within the pharma space, we have a mid-cap idea. Ipca Lab company consistently does well in the domestic market, but they have got a lot of product approval from the US FDA, and that would lead to a growth or recovery in the growth in the US markets. Plus, the Unichem acquisition that is playing out well, and synergies are being witnessed. We are expecting a 26% earnings growth over the next 2 years in Ipca Lab, where again we have a buy rating and a target price of 1930.
Okay. Siddharth, the question I wanted to ask you, poor urban consumption bedeviled us. We saw it in the Q2 numbers, we saw it in the earnings as well as GDP. But the auto sales looked good. Do you think that consumption has returned, that we overestimated the slowdown, or is it really bad and autos are just the outliers?
Yeah, hi, Lata. So I think this time we have clearly seen a big divergence in terms of consumption. While the staples or the daily consumption items are not witnessing the kind of growth, some of the high ticket or the discretionary spending, be it on the real estate side, be it on the jewelry side, on the auto side, auto has seen some recovery after 2-3 months of depressed growth. So definitely there is a big divergence that we are seeing. And what we believe is that we could see from a macroeconomic perspective, there is the overall consumption theme is likely to remain weak, but there would be periods of growth, and more specifically on the large ticket items or discretionary items. It will take at least 2 or 3 more quarters once the RBI cuts down rates, the interest rates come down, and there is a more challenging concern. What you guys were discussing some time back, the retail is where a lot of credit has happened, and we are seeing a lot of credit costs, or you can say NPS, coming out of that segment. And that is where the lending slowdown could also impact spending going forward. So overall, what we believe is there could be pockets of growth, but as a whole, consumption could remain weak for some more time.
And consumption is what we want to address next, Siddharth. But